Okay, good morning and welcome everyone to our third and final hearing. The Commission has done a good deal amount of work so far. I just want to welcome everyone, including testifiers and members of the audience and interested parties. Seeing that we have got a quorum, we've got all of our Commission members here this morning. I guess we'll get rid of some of the formalities, but first thing we need to do is approve the minutes from the prior two meetings. I understand that the commissioners are in receipt of the July 30th, 2018 minutes from that meeting. Can I have a motion to accept those minutes?
Second.
Second, seeing a motion and second, all in favor?
Aye.
Thank you. And September 20th, 2018 meeting, I believe we're all in receipt of those minutes as well. A motion?
So moved.
Second.
Second, thank you. A motion and second, all those in favor?
Aye.
Okay, thank you very much. So as we continue to move down this path, we've got a tremendous responsibility that continues to lie in front of us, and we're moving along very quickly. And I just have to continue to say that I am gratified by the amount and the willingness of world-class testifiers to come to Pennsylvania to try and support our efforts to be as effective as we can with the retirement benefits, the funds that we have under management right now, and helping to improve the performance of our pension organizations. With that said, we will be moving along, and we will be challenged to get our report completed by the end of our 6-month period. There's much testimony that has been developed and will be incorporated into the report. And with that said, we've got a rough draft that we've got right now. We want to submit that and put that in circulation to the commissioners. At this point in time, as I mentioned, the first meeting that we had was on May 30th, and the report is due 6 months after that. And we've got an outline here that I want the commissioners to have. And my hope is, at this point in time, that we'll have an opportunity for each commissioner to take a look at that outline and weigh in with the potential to offer some additions, potentially some commentary on amendments, and an opportunity to develop any additional information that they think needs to be included in the final commission report. With that said, at this point in time, this is a rough draft outline. It is something that is not the final product of the commission. I can just say this, that the commission has tried to be as inclusive as we possibly can in taking testimony that has come forward, and sometimes with a little bit of difficulty. I mean, as you can imagine, going out into the investment arena, it is oftentimes difficult to get people to come to Pennsylvania and offer their expertise. Many have done so, but there were many others that were approached, and the work that has been developed by the commission through testimony, I think, is very, very important, and I think it will help us, again, to have these systems perform at a very high level. At this point in time, we've distributed that, and I just want to try and communicate a little bit more of the potential timeline. My hope would be that prior to Thanksgiving, that we have got any additional information that other commissioners would like to incorporate into our final product, and that would be the week of Thanksgiving week, or the week of the 19th of November. So here's my request. We've gotten a rough outline into the hands of the commissioners. If we can develop any additions or alterations that they think would be important, we'd like to have that information back prior to the 19th of November. At that point in time, I would encourage commission members to work with staff to continue to help develop that document. And for final approval of a document, it is my intention to have a meeting the week of December 12th. So the week of December 12th is when we would like to approve a final document that includes the work that has been consolidated through the offices and the testimony that we have received so far. Commissioner Gallagher.
Thank you, Mr. Chair. I appreciate the
the timeline, that's helpful in terms of the capacity of the commission and those helping us to prepare the report. I would like to just ask, in terms of the logistics, in the effort of not duplicating efforts, how can we best be more efficient in that if we're all working on the same parts of this outline, that seems duplicative. How can we avoid that? Do you have any thoughts on that?
Yeah, so I mean, again, I'll thank the work of the Joint State Government Commission. They are the logistic element of the commission. So we have been communicating generally through them, and I think that the coordination will continue to be done as such. You know, Bernie, as this report comes together, we'll be voting on a final product, and we want you to be able to work with and other commissioners to be able to work with staff. So let's coordinate through joint state government. We will be in close contact with our consultant, Dr. Monk, as well as other people. Susan Boyle from the House staff has been very helpful. The Treasurer's Office has been helpful. We'll try and communicate to the best that we can to make sure that all commentary is included in the report.
Pretty good. Thank you. So is Joint State Government Commission drafting the report, or we should just all send it in and they'll integrate it?
So there will be different elements of the report. Some of them will come from my office, including the help of the legislative staff that we've got here. The Treasurer, their office has also taken much time and effort in coming to some conclusion and opinion. They will include their work in the document. Other commissioners are welcome to do the same, and Joint State Government will be the facilitator.
Fantastic. Given that we are going to give recommendations on transparency, as long as this whole process is transparent, then I think it'll work out great.
Great. Thank you very much. Seeing as we're going to continue to move forward, it's our intent to, prior to November 30th, to have a rough draft, to finalize that draft for December 12th. Again, we want to be as inclusive as we possibly can, and I think the process, quite frankly, it's been gratifying to me. I knew that at the time that this law was established and the commission was established that we would have a lot of work in front of us. And the magnitude of work, quite frankly, was a little bit beyond the scope that I expected. But with all hands on deck, I really, truly believe that we will come up with a document that is a laddered approach that can be given to the General Assembly in their effort to make sure that as an organization that has established these retirement benefits and these retirement organizations, that we are keeping our eye on the ball to expect world-class performance for Pennsylvanians, because they really are a huge part of Pennsylvania's economy, and the fact that retirees are expecting a benefit that they've been promised. It's important for us to be mindful and make sure that we are expecting the performance that we can truly obtain. Is there any comments from any other commissioners at this point in time? Great. Okay, so we've got a busy day in front of us. I'll talk about our first technical difficulty of the day. I believe that on the screens, you'll notice that there is a presentation there, but that will not take place until later in the session, and we're going to just have that there. It's not what we were talking about. I think, Dr. Monk, that will be your presentation later on, but it's my understanding that Sirs and Piecers are not offering any graphics, and we're going to hear from them, I believe, first. I think they are first up. So with that said, we've got recommendations from the systems. Terry Sanchez, the Executive Director of SIRS, Brian Lewis, their Chief Investment Officer of the State Employees Retirement System, will be our first testifiers to the day. We're anxious to hear that testimony. And I'll just note that on October 10th, I sent a note. I think it's often very productive to be able to testify and take a look at yourselves. And I think with an early conversation after the commission was established, I had an opportunity to talk to Ms. Sanchez as well as Glenn Grell from PCERS, and there were some concerns about the way the structures are set up and some opportunity that those systems believed could be taken advantage of for them to operate more effectively and perform better. So with that said, we're anxious to hear testimony today from both PCERS and CERS about just what they see within their operations that might be changed in order for them to operate at peak performance. So welcome to the CERS testifiers. Thank you very much. Okay, Terry, go ahead. Lead us off. Thank you very much.
Morning. Thank you, Mr. Chairman, and members of the Commission for inviting the State Employees Retirement System here today to provide testimony. My name is Terry Sanchez, and I'm the Executive Director of the State Employees Retirement System. Joining me today to testify is Mr. Brian Lewis, our Chief Investment Officer. Brian has been with CERS since 2016. I have been with CERS since May of this year, and I can't think of a better time to be with this organization. For CERS, it's a time of tremendous change on many fronts. Change that as one who stands in a fiduciary status to the 240,000 members of this system, I'm proud to be part of. The State Employees Retirement Board is in the process of enhancing board governance by adopting leading governance policies and practices that improve the effectiveness of the board to better serve the needs of the retirement system's members and employers with corresponding benefits to the taxpayers of Pennsylvania. We're also implementing one of the most comprehensive pieces of pension legislation in the 95-year history of this organization, Act 5 of 2017. And we're evaluating how we can capitalize on this opportunity to better serve all our members. In addition, we have stepped up our efforts to pursue quality investments at reasonable costs. We stand strongly behind our steadfast dedication to honesty and integrity, and we're working hard to further advance our strong commitment towards providing as much transparency as possible without breaching our standard of care and fiduciary duties. I hope you'll come to realize that the goals of this commission and those of the State Employees Retirement System are more alike than different. We're here today to respond to the goals of this commission and those of the State Employees Retirement, to the Commission's request to receive the benefit of our perspective on specific workable actions that can be taken to reduce investment expenses and improve investment and investment-related operations and generate actuarial savings of $1.5 billion over 30 years from the effective date of the legislation that created this commission, Act 5 of 2017. CERS has been committed to finding and implementing positive, practical approaches to strengthen the operational efficiencies and oversight processes of the system, with the ultimate goal of maximizing results for its members and paying promised benefits, benefits that were earned. These are responsibilities we do not take lightly. Last year, the system paid approximately $3.3 billion in benefits to its members. Of that, more than 90%, about $3 billion, was paid to members who live right here in Pennsylvania. These $3 billion represent actual lifelines, providing important means of support and even survival, not only for CERS members, but for the thousands of small businesses across Pennsylvania that rely on them as valued customers. To put this in a long-term perspective, over the 25 years, the CSRS Fund has earned over $50 billion and has paid $48 billion in retirement benefits. The CSRS board and team of investment professionals made difficult investment decisions in the best interest of its members through multiple market environments, cycles of suppressed employer contributions, unfunded benefit enhancements, legislative changes, and challenging political headwinds. In spite of these challenges, CSRS returned 8.4% and outperformed a 60/40 index portfolio net of fees over the same period. In short, we take our responsibilities as legal and fiduciary protectors of our members' retirement funds very seriously, and I think that will become evident throughout our testimony. The fact is, seeking relief from investment fees is a way of life at CSRS. The system has been reducing investment manager expenses over the past several years, and in the past year has reduced annual investment manager expenses by $32 million. That would be 46, our expenses have been reduced to 46 basis points. We're happy to have the opportunity to share our plans and perspectives and even some of the accomplishments that have been realized since the beginning of 2016. Before we get to those cost-saving items, however, I'd like to take just a moment to assure the Commission, our members, and the public that the State Employees Retirement Board has an ongoing commitment to demonstrate transparency in its reporting of fees and investment expenses while working within our legal and fiduciary framework. Each year, CSRS reports investment and investment-related expenses, including ongoing management fees and performance or incentive fees, to the general public in 2 reports: our supplemental budget book and our comprehensive annual financial report. Although CSRS reports management fees and expenses paid to private partnerships, these amounts are typically returned to CSRS later in the investment cycle. These returned amounts, however, are not retroactively adjusted in CSRS fee reporting. So if anything, these management fees and expenses are overstated. In an effort to ensure that all management fees and expenses are calculated and audited in a consistent, ongoing manner, CSRS Office of Finance and Administration has created and implemented internal controls that comprise very detailed processes and methodologies. It's a multi-step process designed to ensure that all relevant financial data reconciles and that management fees are calculated accurately and reported properly so we don't pay more than the contractually negotiated amount. Where the confusion comes in is with the term profit sharing, what the industry refers to as carried interest. It is our opinion and the opinion of some of the previous testifiers, as well as others in the industry, that carried interest is not a fee. In exchange for providing the capital for an investment, CSRS is entitled to the majority, typically 80%, of the partnership profits. The general partner then receives its share of the profits, typically 20%, minus fees and expenses as noted. The general partner profits are determined only after, 1, all prior management fees and expenses paid by CSRS are returned to CSRS, and 2, the capital contributed by CSRS is also returned to CSRS. While we understand that the general partner's 20% of the profits of a successful investment could be a significant amount, this type of compensation structure works very well to align the interest of the general partner with those of CSRS. When the general partner succeeds, CSRS succeeds. Typically, for every dollar of profit the general partner receives, SERVS receives 4. That being said, because SERVS and others in the industry do not consider carried interest as a fee, it isn't something that historically has been reported or tracked by SERVS. It was never hidden, and there's nothing shady going on here. It simply wasn't something that was reported or tracked. And there's a very big difference between one and the other. We're working in the midst of an industry where new standards are emerging, and SERVS is open to these standards. In fact, State Employees Retirement Board Motion 2018-15, passed just this April, specifically directed SERVS staff to request general partners of new investment opportunities in private markets to begin adopting and completing the Institutional Limited Partner Association fee disclosure template, effective immediately. Similar requests are being made of general partners of existing investments in private markets, effective January 1, 2019. So we are well underway in our efforts. Thank you for your indulgence in letting me shine some light on this important matter. I'll now turn the microphone over to Brian Lewis, our Chief Investment Officer, to discuss our ideas for cost savings.
Thank you, Terry. Let me first say that SERVS believes that the benchmark $1.5 billion in actuarial savings stated by the Commission is an achievable goal. To arrive at that conclusion, we work closely with our actuarial partners at Korn Ferry to perform projections as to what it would take to reach the $1.5 billion mark. Based on the projected assets for each of the next 30 years, we estimate that if the fund were to reduce investment costs by 4.5 basis points and sustain that reduction in each of those 30 years, it will be sufficient to create an estimated actuarial savings of $1.5 billion as of June 2047. For the record, we were working diligently on ways to trim investment expenses even before Act 5 became law. Since the beginning of 2016, SERVS implemented a number of measures to reduce costs. We transferred $2.5 billion of actively managed public stocks and strategies from active management into low-cost investment strategies. At this point, nearly 80% of SERVS' public stock portfolio is invested in low-cost investment strategies. We negotiated lower fee structures with public stock and fixed income managers as a part of our ongoing due diligence, not because it was a new initiative, but because it's a part of the process of managing a portfolio. We liquidated 8 hedge fund strategies and transferred nearly $900 million from these hedge funds to strategies that include low-cost investments. We consolidated fixed income portfolios to take advantage of more favorable fee structures. Within private equity, we've negotiated to have supplemental components to our investments called sidecars that charge no fees, thereby reducing the management fee in the total investment. We've invested in private equity co-investment vehicles with no fees charged on committed capital. We've gotten a 35% reduction in some cases on the invested capital and a 50% reduction in the general partner's profit sharing due to this agreement. We reduced the number of private equity managers in which SERVS has invested and our pacing model while increasing the size of our commitments, thereby hitting certain investment size thresholds to reduce management fees. We've also worked closely with our sister system, PSERS, so that the two agencies who invested in the same investment opportunity recently could benefit from reduced fees based on that combined effort. So naturally, we are proud of what we've accomplished thus far, but we are not finished yet. At the direction of SERVS Board, we continue to work with our consultants to pursue cost savings wherever feasible and beneficial to the fund with investment risk and return considered. One cost reduction tactic is to participate in no fee, no carry or reduce fee, reduce carry co-investments alongside general partners with whom SERVS has made primary fund commitments. These co-investments help reduce the aggregate fee burden on dollars deployed with general partners. As noted, we already are working with several general partners who offer co-investments to CSRS and have expressed further interest in completing co-investments. Another key cost reduction CSRS has begun implementing is negotiating management fee reductions with the eye towards founders' fees or first closer terms. Private equity and real estate funds sometimes offer incentives to first or early closers by offering management fee discounts. Where possible, CSRS can achieve these discounts by committing to general partners in a first close. The resulting management fee discounts can range from 5 to 25 basis points. Another way we continue to reduce investment expenses related to management fees is through building strategic partnerships with managers that invest across various fund products. The formation of strategic partnerships typically involves large commitments to managers that are divided at an agreed upon ratio among various strategies in which the manager actively invests. Such partnerships are often diversified across sub-strategies, geographies, and investment types, thereby creating diversification within the broader portfolio. CSRS is also researching internal asset management opportunities for both public and private markets that are designed to reduce the amount of fees paid to external managers. To ensure CSRS is implementing a best-in-class framework, we plan to contract with a consultant to assess CSRS' existing systems and processes, identify operational risks, gaps in current infrastructure, and human resource requirements, and then present a viable solution that details the pros and cons of the various options, systems, portfolio management, trading, middle and back office functions, compliance, and risk management. And we will also ask the consultant to help us evaluate the cost of the successful implementation of an internal asset management program. With that, I'll turn back to Terry.
Thank you, Brian. And thank you to the Commission for asking us for our perspective on what the General Assembly can do to help us improve efficiencies and reduce costs. The State Employees Retirement Board and staff stand in direct fiduciary status to the fund. All of the requests that follow are absolutely consistent with the fiduciary responsibilities and duties of the board and staff in administering the fund for the exclusive benefit of the members with the skill and care that a person familiar with such matters would exercise. Specifically, we would ask that the board be given the decision-making authority for organization, position complement, and compensation for management employees in place of the Commonwealth's Executive Board. Having maximum flexibility in the ability to increase our staffing complement will allow us to continue with the cost-saving improvements that are already underway. The addition of high-quality, specialized staff in the investment and investment accounting areas will help us to improve our investment and financial operations and audit capabilities and to reduce costs. Increasing our staffing complement will also enhance our ongoing effort to implement and grow our internal asset management capabilities. We've seen the promise that this effort holds from our own experience and from learning about the actions taken by some of the elite public pension funds. Having control over the ability to set compensation levels allows the board to attract and retain high-quality expertise. We ask that the board be given greater flexibility to more efficiently procure goods and services. We ask that the board be given the ability to determine its budget without having the Office of the Budget approve or alter the board's budget request. There is no entity better positioned to make the necessary fiduciary decisions regarding the investments and disbursements of any of the monies of the fund than the board. In addition to the specific items listed above, I would ask the General Assembly to remember that administrative limitations imposed upon the ability of the board to efficiently administer the fund and manage CSRS operations and any restrictions on how the board can invest the assets of the fund have consequences. Administrative burdens or substantive restrictions can, to a greater or lesser degree, increase costs or reduce the ability of the board to achieve desired investment returns. This applies to both current statutory regimes or future statutory changes. The board must be given maximum administrative flexibility and investment authority in its ability to satisfy its fiduciary duties and obligations. The items just stated are all important and achievable goals. That there is one more that holds even greater promise and would go a long way towards demonstrating that Pennsylvania is serious about its commitment to public pension reform. This is by far our biggest ask, if you will. I ask the Commission to consider the benefits to the fund, to the members, and to the Commonwealth of consistently paying the actuarially required contributions to the fund year after year, as this administration and the General Assembly have done for what is now the third year in a row, and I thank you for that. An amount that, combined with investment earnings, would be sufficient to pay promised benefits in full in a cost-effective manner. We have seen firsthand how persistent underfunding can jeopardize a plan's sustainability, eating away at the asset base, forcing decisions to liquidate investments at the most inopportune times, and pushing a retirement board to reach for returns that it otherwise may not need to. Returns that are often reached through expensive investment alternatives. At a previous hearing, we heard testimony from other systems who had more passive, less expensive investment strategies than CSRS. It is important to note that these systems acknowledged that had they not been in the healthy financial position that they were, their investment approach would not be possible. After years of suppressed contribution rates, CSRS is not in that position. And given our position, alternative types of investments are critical to meeting the assumed rate of return so that we can continue to pay promised benefits in perpetuity. None of us want to take unnecessary risk. And quite frankly, as fiduciaries, we cannot and should not take unnecessary risk. Perhaps this commission can help position us so that we can, in good conscience, move towards an asset allocation where we not only look to get the best return for the risk we take, but where we also can take less risk overall and pay promised benefits cost effectively. So how might you do that? One way would be to recommend consideration of amendment to the Constitution that requires the legislature to incorporate into the State Employees Retirement Code a dedicated funding source and a contribution payment amount that is based on sound actuarial methods and assumptions consistent with generally accepted actuarial standards of practice. Ensuring funding at an amount that cannot be impaired by the changing priorities of elected officials, insulating it from the unpredictability of the appropriations process, and preventing the manipulation of amortization methods and other funding deferral mechanisms that have cost the system approximately $8 billion through 2017. Those assets could have offset the unfunded liability and provided more investment flexibility to the retirement board. Flexibility that may well have included an asset allocation with more lower cost investments. What has been suggested here is a heavy lift, no doubt, but it is a lift that several states have already made, some in reaction to situations much more dire than ours. But perhaps Pennsylvania has an opportunity to be proactive and attempt to implement elements of the Government Finance Officers Association funding best practices and of the Conference of Consulting Actuaries funding policies and practice guidelines now, preserving the good that this administration and General Assembly have accomplished, and ensuring that future administrations and General Assemblies do the same. Thank you for your time and your attention to this critical issue, and we're happy to take your questions.
Ms. Sanchez, Mr. Lewis, thank you so much for your testimony. It's really important. Your perspective is really important, and you're right, there's a lot of heavy lifting that needs to be done. And I just want to acknowledge the fact that the Auditor General did an audit of your organization, I think, in July of 2017, and it acknowledges some of your work towards fee savings. And we're gratified to hear, I think, that you believe that you can get to $1.5 billion in savings. That's terrific. It's a terrific prospect for the future of the Commonwealth and for the participants in these plans. There's many people in 2010 that didn't think we could stick with a payment schedule to get to the ARC. And I can tell you, I think that the General Assembly has gotten a wake-up call with our massive underfunding right now, and we certainly don't want to go back to days of underfunding systems that are so very important as we continue to dig our way out of the hole. And I also thank you for your initial comments that we are very much aligned, and I hope that this relationship works out to be a very fruitful one, in that recommendations that are delivered to the General Assembly and the administration, and inevitably the systems SIRS are acted upon, and we can maybe even do better than that $1.5 billion. I hear some of your recommendations to the Commission and your belief, and I have not been in this room very often where I haven't heard less mandates and more money. It's a popular theme among every organization that we deal with, and I get it and I understand it, and I think that you're spot on in pointing out the fact that underfunding over a long period of time has gotten us in the circumstances that we find ourselves in right now. But as far as more specifically in the governance area, you talk about more flexibility with your board. Is there any other governance changes that you believe could be implemented to the way that these systems, your system in particular, is managed to make you more effective and end up being able to deliver better results?
We'll start with that, Brian. I think there are some things that we can do to improve our governance. In fact, we're currently in the process of implementing a number of governance improvements that we had taken on when we did a study the board had a study done a few years ago by Funston. And specifically, we asked them to come in and take a look at the board's governance structure and processes. They've worked on that for well over 2 years, and I'm very happy to say that just at the last board meeting, we approved a number of changes, and we are approving more that will take effect around January 1st of 2019, and those things should have a significant impact on the way, and the efficiency and how the board operates, and the board itself is very happy to have those things implemented.
I would say from an investment perspective, I would reiterate our ask for the board to have the ability to have complete complement and budget control, to give us the resources and the flexibility and speed to be able to set up an organization to be able to most efficiently manage the assets. So we talked about internal management as a possible opportunity for us. As I'm sure you've heard before, there's an initial investment for staff and systems to build up in order to achieve those long-term cost savings. Particularly within private investments, we see some of the world-class and top pension funds have very sizable staffs, but they also have very minimal cost as it relates to these types of investments. And so it's my understanding under the current process of both staffing, complement approval, and budgeting, it sometimes is not as dynamic as the system may need to be able to build out the scope in an effective manner to reach the efficiencies that we would like, in a timely manner.
So, I mean, the system was established, I think, in 1923, so you're going to be 100 years old pretty soon, and I think the law that you're acting under right now is from 1974. But you're exactly right. I mean, the General Assembly, they determine the retirement classes, and they determine the benefit levels, and determine the payment schedules, and they determine ultimately the governance. What do you think about the appointment process and the way your boards are structured and made up?
I think that's probably best left up to the policymakers. We try to have a board, work with whatever board that we have that leads our system and support their initiatives. My most important thing is that whatever board we have takes their duties as a fiduciary as its foremost duty. However we can do that, certainly would be supportive of, and I'm not saying that our current board does not. I'm just saying, should there be any changes, their role as a fiduciary to the members of our system are most important.
Okay, thanks. So you work with your peers sometimes. Do you see any other systems similar to yours that have a bit different board structures? You think they're more effective as a result?
I haven't specifically spent a lot of time looking at that. I'm sorry to say, but I can go back and get some research and get that to the commission.
That's great. I just want to bring up two other terms really quickly. I don't want to take too much time here, but we live in a world right now, two terms are held in high regard. Number one, confidentiality. Number two, transparency, right? But they're competing interests at some point in time. Just tell me a little bit about the culture of SERS and the idea of transparency as we evolve in a more transparent world, and the idea that ILPA now is setting up a framework that we can operate, a blueprint that hopefully we can all operate within, that makes us a little bit more visible.
From an investment reporting perspective, we've seen the industry become a lot more transparent within the last 5 and 10 years, particularly within private equity and private real estate, where the ILPA template will become most useful for us in gaining the information and having the ability to report it. It's a welcomed change for not only us at SERS, but I think the industry at large. And we're completely supportive of that, and we look forward to working with our GPs to make sure we get all that information to be able to provide it and report it as requested, required, and in the most transparent manner as possible.
Great. Thank you. Thank you again. Mr. Vice Chairman, questions?
Thank you, Mr. Chairman. It's good to be here. Thank you to everyone who's from the commission, to commissioners, the Joint State Government Commission, to our witnesses. And I note the hint from my fellow commissioners. I'm the only person who got a jar of mint-flavored chewing gum here this morning, so I assume that is a message from someone to me. Terry and Brian, thank you. I want to, number one, underscore what you said about the importance of the ARC, and I think that the importance of making the ARC, and I think that's something we can never say too much. It's been some good recent history, but it's very recent history. And if it represents a new chapter in a longer story, that's encouraging, and let's hope it does and do our part to make it so. I also want to echo what the chairman said about the efforts that you have made to reduce investing costs, which are broader than just fees, but costs. And as I said yesterday, I think the change from 2016 to 2017 is worthy of note and praise. I think that's a substantial reduction in the basis point cost of investing the funds, and SERS deserves applause for that. I have issues with what we're not reporting yet, but believe that you are headed in the right direction in getting there, and that year over year that represents real progress and should be held up for praise. I want to ask you, the savings that you've achieved, do you believe any of them have come at the expense of return?
I would say that in some cases on the public side, in the short term, the answer is no. I would say in the private investments, that will remain to be seen, as you're well aware of the structures and how the fees and expenses are calculated and discounted, and there are a longer time period just from an investment horizon. But I would say on the public side, the efforts we have taken have not impacted the returns.
Sure. But on the private side, leaving aside the judgment of history, when you made your changes, you believed you could both achieve the savings and the return.
Yes, both
Okay.
considerations, and I believe we can.
On the discussion about resources and complement and autonomy, I want to ask if that request is made in the context of thinking about SERS or thinking about how SERS and PSERS might work together in a different future where there's some more explicit cooperation and consolidation.
I would say my thought in making that request is under the current construct and operating environment. However, the basis of that request is based on broader industry practice and examples of success of having the right number of investment professionals to manage the assets that a plan is responsible for. But I would say, in general terms, both organizations or all organizations, even if we are, as we have done in certain limited yet productive ways, work together, having enough resources to coordinate effectively is very important. And so I would not say that PSERS will have to speak on their own behalf as it relates to their needs and their requirements. But I think for any organization managing over $30 billion, it's important to make sure you have enough of the appropriate resources to do that.
Sure. And the point on alternatives, and I don't think I heard the testimony of some of the other state systems quite the same way you did. I thought they were talking about something broader than a focus on cost. They were talking about the particular ways they operated with a lot of in-house and some other, and a certain degree of autonomy, but we can get some clarification. But on the idea that alternatives are the only sure way of achieving higher returns, I guess I'd like you to talk about the experience at SERS with real estate and hedge funds in recent history, with what kind of implications. And again, you're not responsible for the history of the fund. You're both relatively new to the fund and have been moving in some great directions. But as an object lesson in how much we can say for certain what's going to work when we pay for those investments.
I think I'd like to take the approach of answering the question of saying that we don't believe that alternatives are the only way, and we don't also believe that what the other CIOs who presented here earlier stated that it was an either or. It's the organization, based on the investment policy and strategic plan, it's our belief that we are required to provide a well-diversified portfolio that will give us the best opportunity to meet our required return in all market environments. And it is our belief that alternatives as a percentage of the portfolio will give us a better opportunity to meet the required return over longer market cycles. As you know from our asset allocation, 60% of our portfolio, over 60% of our portfolio is in public markets as it stands today. And there is no concerted effort to reduce the importance of public markets and public investments in the portfolio. They provide great benefits such as liquidity, the ability for us to pay benefits in an efficient and less detrimental way. However, we do believe, given the expected returns going forward and the market environments, the market return environments, that alternatives have a place within a well-diversified portfolio.
Thank you.
Commissioner Gallagher.
Thank you, Mr. Chair, and thank you, you know, Ms. Sanchez and Mr. Lewis. I'm still stunned by the fact that the system has provided $50 billion in benefits to our annuitants and retirees out there, and I can see that being a tremendous gyroscope to our economy in Pennsylvania. So thank you for making that happen every day. And again, I'm still staggered that I'm shocked that some of the policy decisions that were made under this roof not that long ago cost our system $8 billion. And you're in the position of needing to pick up the pieces. So thank you for enduring that and doing the best you can every day. My question is this. There's been some emotionally charged headlines recently accusing the system of hiding fees. Over the last 8 years, I've been working on pension issues, and specifically 5 years at the board level at SERS. I've seen nothing but that, nothing to that. There has been nothing whatsoever but transparency and full disclosure on everything that the system is doing operationally. I was flabbergasted seeing these headlines as they started rolling through shortly after the last commission meeting. The statements were made and testimony was provided that I found to be patently misleading based on my expertise in this subject area. Can you both clarify for the record, is SERS hiding fees?
No. Plain and simple.
No.
Thank you. Appreciate that. So I understood, for the record, the system is not hiding fees. However, I would hope that some headlines in the near future will reflect a more fair and balanced approach to what the systems are doing that's positive on a moving forward basis. Thank you.
Thank you, Commissioner Torbert.
As a retired portfolio manager in a wealth management and trust department, fiduciary was always a big word. It scared a lot of bankers. It didn't bother us in our department, but it sure bothered or worried them. Because you always have to put the client first, so that means you have to be transparent, you have to be open, and you have to make sure that they have a comfort level. But I was always on the individual side, not on the institutional side. So there's a little bit of difference there, but the bottom line is always the client. And to me, that was always the strong point of anything I ever did. Having said that, I laud you for all the work that you're currently doing regarding the fees and the investments that you're already doing. And most of yours is in public equities. I was always used to public equities, whether they be bonds or stocks or whatever. And we always wanted to make sure we had liquidity. And that's what concerns me about the private equities. Now, I see a need for private equity, but it also concerns me about the length of time that you're kind of locked into them when you're in a fiduciary capacity. So anytime you can bring that down and make sure those fees are as transparent as possible, which sounds like you are doing that. I was very delighted to hear that you currently work with PCERS. I was under the impression years ago, and even before I got on this commission, that they were two separate entities and they didn't really work together a lot. So to me, that made no sense, because if I have a family relationship, you may have 10 accounts in that relationship. Well, guess what? It all gets combined for free purposes. And so it made sense for, you have Pennsylvania and you have the two systems. It makes sense that you work together if you're working on the same investments to bring down the cost. That's the way I did it. So I'm glad to hear that you're all doing that, and hopefully I'll hear that from PCERS as well. I mentioned liquidity, and funding is always a subject that has come up in a lot of the people that have been testifying here. So a consistent funding from the legislature is probably important as well. I was on a school board for 8 years in the Allentown area, and at times the funding was up, and at times the percentage went down a little bit. So a constant funding, it probably makes a whole lot of sense, especially in the marketplace that we have now. So thank you very much for your work, and continue success.
Thank you, Commissioner Bloom.
Thank you, and thank you for your work. And I know that in a sense you've just certainly, Terry, you've just arrived, and I've seen you in action. I've seen the boards in action. I've been at the last couple of meetings, and it's been very impressive. The idea of which was addressed here a couple of seconds ago about hiding fees. That's probably a bad choice of words, but in order to compare how the systems would have done if their money was in public markets as opposed to private markets, you really have to know what the carried interest is, because that's part of a calculation to make a comparison between returns from the public and private as to how much you would have put up. And I think that's kind of where the missing money is. So I just wanted to kind of clarify that. And I don't think anybody hid. I think that that's normal practice in a lot of places. It's not a good practice. And it's obvious that SERS and your board are addressing that issue. And I think that's very important. Now I'd like to get into the weeds. And Mr. Chairman, if I'm too much into the weeds, please correct me or tell me to quiet down. You have about, as I can see, about 450 GPs, general partners in private equity. Some of those are performing, some of those you've labeled as underperforming assets. And you're going to do something to try and market those, I believe, and move them out. I have a bit of, I'm not an accountant, but I have a bit of auditing experience. So if you have 450 GPs, I don't know whether my number is right, but I think it's over 400. You've got 400, according to what I heard yesterday, there are 400 or so accounting firms that are coming back and telling you that their net asset values are good. I don't know whether those accounting firms are simply reviewing the general partner's numbers, or are they rather reviewing the some of the investments of the general partners, because now you're talking about thousands of companies. How confident are you in the net asset value numbers that you get? Some of those in the ones that are underperforming, I've had some experience in this, are probably less than what you're currently reporting. And if you're going to sell them, you must have some idea about what that price is. And if that price is less than what you're valuating it now, when you take your audit snapshot, that's where they, in my opinion, that's where they should be priced. The other thing I was told is, in speaking to various people from the pension funds, is that the active, large net asset values you get are probably undervalued, that they are probably valued at about 90%, 85% of what they're going to be sold at, okay? Again, back to the auditing, they should be valued at what they're worth. I mean, if the general partner thinks they're worth $50 million and they're telling you they're worth $40 million, it's not accurate. So somewhere it kind of skews your overall numbers and what you're reporting as to what your net assets are, if any of this is right. So maybe you could address that for one or 2 minutes, because I've probably taken up too much time. Am I too far in the weeds? Thank you.
Sure. Let me address a few of the points. You're correct. We do have a lot of general partner relationships. I think the number 450 is slightly higher than my count. However, we have gone through a process of identifying what we call core versus non-core. So managers that have performed and we feel as though we want to continue to have relationships with, because their strategies fit within our strategic investment plan. Those non-core relationships have been transferred due to board approval and action to an asset management firm that will take over the administration of those non-core funds. According to my account, that's approximately 162 relationships. That fund will become the day-to-day administrator with oversight by the Service Investment Office staff and the board. So there's been no ceding of ownership or control of decision-making with this process. We, in effect, due to understaffing, have outsourced the day-to-day management and interaction of what we're calling these non-core funds. So we feel that this firm will be able to help us and provide us with opportunities on the best ways to either end those relationships, determine a secondary market value, or manage them through termination of the agreement. And so that was an operational decision. As it relates to the NAV and calculation of the information, I am, and the staff is very confident that the information that we've reported in the budget book and CAFR for a number of years, not just recently with myself and Terry joining, throughout history has been accurate, and there's a process that has been in place to help evaluate the accuracy of the data, not only that we receive, but also the data that we report. So each of our GPs have audited financial statements that are audited by the largest Big Four accounting firms and folks who specialize in investment accounting, not only on their calculation, but also on their valuations. That information that we receive, we have an internal investment accounting department that also has processes and procedures that checks and validates information that we receive. And then the third important component is we also, SIRS, we have an auditor who comes in and will check not only this process, calculation, to make sure that it is valid and there have been no material findings through this process for a number of years of any inaccurate information. A final component that we have is our private equity consultant we have a relationship with their back office and operation team. They come to our office twice a year to do a review of the private equity information in-house, as well as continued conversation between the investment staff and office. Now, this connects a couple points. One, it's a fourth layer of checking on our information as it's received. But finally, this too was another example, Mr. Chairman, of with the right complement, with the ability to hire and invest, this is an activity that could be done internally, potentially at a reduced cost. But right now, we utilize the expertise of a private equity consultant and their operations team to help us out.
When you decided what was non-core, was there any conversation about what the value of the non-core would be on the secondary market? And that's really a loaded question, because if you say yes, then that value is the value you should be reporting. So do you have any comment on what you think the percentage is, the haircut is on the non-core?
I would say that the evaluation on the non-core has not been completed as of yet to determine a full secondary value, but that is a part of the process that the board will be presented in future meetings.
Thank you very much. I'm sorry about the tough questions, but it's just something that I have been talking about since the very beginning of this process. Thank you so much, both of you, and we appreciate the work that you're doing.
Commissioner Bloom, thank you so much for that question. I think it's important for us to have heard the direction that you're going with those general partner relationships. And I think you have one follow-up question, Mr. Vice Chair.
I do. Just following up on something Commissioner Bloom said. And again, understanding that in the world of private equity, things have changed a lot in 10 years, and that at SIRS, things have changed a lot in 10 years, and forget about how we got here, but if I understand from your testimony that you haven't historically reported or tracked carried interest, let's agree we won't call it a fee, but is carried interest a profit share? Is it a cost of investing in your view?
It is not a cost of investing, in my view. It is a benefit of outperformance for both the GP and the LP.
So you don't view it as a cost?
I don't view it as a cost, but
Should it be reported and tracked?
I am comfortable. I agree that it can be reported and tracked. I'm comfortable with that.
Okay, thank you. And then just one final question. We'll get on to our next testifier, Commissioner Torbert.
Going back to that liquidity idea, do you have a timeline or a time horizon when you get into a private equity as to how long you're willing to be locked in?
Yes. So we manage liquidity we monitor it on a daily basis, and we report out our liquidity to our board at every board meeting. So folks are fully aware of the liquidity that we have, and we have a liquidity schedule that me and my team monitor as it relates to daily, monthly, quarterly, and annual liquidity availability of different types of investments. So through that process, when we recommend to the board to make a commitment for any type of vehicle, be it private credit, private real estate, private equity broadly, we have a good understanding of the amount of time based on the general time frame for these relationships in a private equity agreement will be 10 years. With the possibility 2 years of extension. However, it's important to note that it doesn't mean that all of your capital is locked up for that entire period. Because of the mechanics of the investment process, when a commitment is made, while we are responsible for making sure we have liquidity if that capital is called, generally all the capital is not called at one time, and all the capital is not retained until the end of the contract period. So there are constant calls and distributions that we also track and maintain to make sure that we have enough liquidity to meet the private needs. But more importantly, Mr. Commissioner, is the fact that our liquidity focus is on making sure we have the ability to make our monthly payments to our members. And so we have more than multiple time periods of liquidity allocation as well as scenario analysis that we run in different time periods. For example, if we don't receive contributions from our employer, then we have to still have enough liquidity to be able to pay our members. If, as we have over the last 3 years, we do continue to receive, and we hope that is the case, it makes it a whole lot easier to manage liquidity when you have a dedicated and disciplined funding policy. We have those, and we've been operating under that scenario for the last 3 years. And so when we think about where liquidity comes from, how much liquidity we have in the portfolio, the majority of those conversations are on the public side of the house that you're familiar with, which again is over 60% of our portfolio right now.
Then one quick last one. Can you do mark-to-markets on your private equities on a regular basis or any kind of basis?
Well, one of the challenges with private equity is just in the name, right? Private and when they're valued.
Yeah.
So we report on the valuations on a quarterly basis to our board, but even that information is in a quarter lag because of the valuation process. So in the traditional public mark-to-market sense, the structure would not allow for that. But again, we do get valuation updates and monitor valuation on a regular basis.
Thank you.
One second, Mr. Chairman. I have one just quick follow-up. It's more of a statement, I think, than a question. That in response to what Commissioner Torbert said, that all of private equity and frankly, real estate and other investments too, are based on estimates, and I think what the industry term is unobservable data. So, in a sense, they are, albeit very educated. There is, they're, for want of a better word, they're approximations or guesses on what the value of these are when they're in the intermediate state.
Okay, again, I thank you for your testimony. I've asked this for all testifiers, and it's particularly important for the two systems that just ask for your availability as we get down the stretch. I know you have an awful lot to do, but your understanding of your operation is really important as we get down the stretch here and complete this. So your ability to communicate with our consultant or commission is really important for us. Again, and thank you for all the work you're doing on behalf of the Commonwealth of Pennsylvania, its retirees, and everybody. Thank you very much for your testimony.
And again, thank you for the opportunity for Brian and I to be here on behalf of the State Employees Retirement Board.
Great. Okay. As they exit the stage, I'm going to introduce our next set of testifiers, and is from the Public School Employees Retirement System. We've got Mr. Glenn Grell, who's a former colleague of mine, was with the General Assembly from. Wow, Glenn, I'm not even sure. He was first elected in 2004, and I'm not sure the date that you left service, but we appreciate your continued service here to the Commonwealth of Pennsylvania. Glenn has wore many different hats here in the Commonwealth, including being a Shippensburg University Council of Trustee member since 1995. And he is joined by Jim Grossman, who is the Chief Investment Officer for PEACers. And we see that you're bringing Tony along with you as well. So you've got backup. Jim, welcome today, an Elizabethtown graduate. I didn't realize that myself as well, so that's really great. We appreciate you being here today. And as I mentioned before, we had the commission is interested in hearing about specifically how your organization can help this commission produce its charge on a number of fronts. Cost savings, certainly stress testing, transparency are all in the wheelhouse of what we're trying to accomplish here. I thank you for being here, and we are anxious to hear your testimony. Thank you.
Okay. Excuse me. Good morning. And thank you for the opportunity to be here. Chairman Tobash, good to see you. Treasurer Torsella, and members of the commission, good morning. My name is Glenn Grell. I'm the Executive Director of PEACers, and with me today is Jim Grossman, our Chief Investment Officer. First, I want to thank those commission members who, I believe it was all of you, who attended our August board meeting and our committee meetings, which included our asset liability study and our asset allocation process. We hope your attendance at that meeting gave you a clearer understanding of how PEACers approaches those important processes. Also, thanks to Commissioner Bloom, who joined us at our recent October board and committee meetings, as well as him having a one-on-one meeting with Jim Grossman recently. Before we present our ongoing fee savings and efficiency recommendations, I want to take a few moments just to address what we believe is a false narrative that's been created and circulated and unfortunately continues to be circulated surrounding these hearings regarding PEACers. To date, PEACers has taken the high road and not engaged in any kind of negative public debate on these topics. We prefer to engage in these issues in a thoughtful, professional, factual, and principled manner. Having said that, we believe the right time to address some of those outrageous allegations is at today's hearings, and when we finally have an opportunity to address the entire commission in person. PEACers has a duty and a responsibility to address these allegations and what we believe are politically motivated hyperbole about hiding fees and wasting system assets. Wasting is it's a touch word, a very sensitive word with any fiduciary, and that particular narrative has to be addressed. 2 points to make regarding this public commentary. One, PSERS does not waste system assets. This is a fact, and in our view, it's not up for debate. Saying PSERS wasted funds is irresponsible and insulting to every PSERS employee who works hard each and every day on behalf of our members with only the best interests of our members in mind. This false narrative also disparages our board members who volunteer and devote a significant amount of their time and expertise to the PSERS to serve on the PSERS board. As those of you who have attended PSERS committee and board meetings know, these meetings are very long. The board packet contains thorough and extensive due diligence write-ups on investment opportunities, as well as detailed materials on the often overlooked benefits administration side of the agency. The ensuing discussion at board meetings can result in questions, dialogue, and vigorous debate on potential investments and other administrative agenda items. The specific assertion is that PSERS wasted $3.9 billion in fees to Wall Street managers. The fact is that PSERS engages and compensates money managers in areas where we can't internally manage the investment, and only after due diligence of the manager. We carefully track the manager and the investment to make sure we are getting value for these fees, and we report asset class and manager performance to our Board of Trustees. While not every investment is productive, and we frequently terminate underperforming managers, the value of these external managers fully justifies the fees paid. Over the past 20 fiscal years, PSERS has outperformed a global 60/40 portfolio by 84 basis points. In dollars, PSERS generated $10 billion in performance above a global 60/40 passive portfolio at a cost of $6.9 billion. Net investment income during the past 20 years was approximately $62 billion, but it would have been only $52 billion had we followed a passive, no-cost global 60/40 index portfolio. Hardly a waste of system assets in our view. Point number 2, PSERS does not hide fees, and maybe I'm preempting Commissioner Gallagher's question. Another charge of this commission is that the funds have hidden billions of dollars in fees. On the contrary, PSERS has long been a leader in fee transparency. While the Government Accounting Standards Board, known as GASB, only requires the reporting of, quote, readily separable fees, PSERS professionals have gone above and beyond the reporting requirements of the GASB, releasing both readily separable as well as not readily separable fees. PSERS discloses them annually in our comprehensive annual financial report, our annual budget request to the General Assembly, and in an annual presentation to the Board of Trustees. At PSERS, we pay strict adherence to reporting standards, and we take great pride in having been recognized for 34 straight years for excellence in public financial reporting.
Mr. Grell, thank you for addressing these things. I just want to get back to a point, and if you want to submit some of your comments for the record, I'm happy to do that. But this commission is specifically charged with a task, and I've asked both sirs in your organization to come forward, and in the letter dated October 10th and in previous conversations, we talked about your appearance and testimony before the commission is an opportunity for the commission members to receive the benefit of your perspective on workable actions. I specifically asked that we have been established in assisting you, and we want to be partners in this. And I think we've brought great expertise from throughout the country and sometimes from throughout the world at lowering costs while meeting or exceeding your established discount rates. I don't want to get into a debate here on what you have done in the past, but preferably we'd like to hear from the systems on what changes you believe need to be implemented for you to operate better. And we live in a very public world. So I'm interested to hear that. And if you want to offer commentary on your testimony, we will do our very best to include it in our submission. But at this point in time, I really believe that your time is better spent talking about what implementations might be recommended to help you perform at an even higher level than you're claiming that you have performed so far. So
in that case, I will simply refer to the discussion that Executive Director Sanchez had on the same subject, which you didn't cut off, And I'll continue discussing this topic with anybody that's interested in the hall after our testimony. I will then
thank
move
you.
on.
Mr. Chair, it seems to me that the subject that Mr. Grell was speaking to is germane to the charges of our commission in terms of fees and transparency. So I didn't hear anything outside the realm of our charges, but again, I recognize that you sent that letter, but that was just from one commission member, but not from the commission, and I would like to hear this.
So, Commissioner Gallagher, you'll have an opportunity to ask questions, and if you want to ask them in this vein and you want to have Piecers respond in that regard, then we'll allow that at that point in time. But if we could move on to the part of your testimony that talks about what we might do to improve your system from your perspective, I would much appreciate that.
Okay. The remainder of my comments on carried interest and whether or not Piecers hides fees is included in the written testimony, and I'll be happy to further discuss it in the question and answers. Before then moving to the testimony specifically on our fee reduction plan, which has been submitted and approved by our board, I want to offer some research and analysis that we've compiled while waiting for our opportunity to appear before the Commission. You're correct, Chairman Tobash, you did make it clear not to dwell on our views of your prior witnesses, and we're not going to do that, and you were not interested in explanations of how we operate. So for the record, we're simply going to submit a bundle of materials for the Commission's consideration. We have what we've referred to as a compendium of research, which we believe we've itemized about 35 or so pieces of research. This is the information that we're going to leave with you. We believe it is relevant to the issues you're considering, and it's also indicative of the kinds of information that we rely upon regularly to inform the approach that we take and we recommend to our board in terms of managing the portfolio. So I will just submit one copy of that information for the record. Moving then to the subject of manager fees and efforts to reduce them. I want to take you back about 3 years ago, shortly after I became the executive director of Piecers. At that time, Governor Wolf, newly elected, had expressed an interest in the investment operations at both of the funds. We were asked to meet with Governor Wolf and to review our investment policies and our strategies. In an effort to be professional and thorough, Piecers prepared a slide deck of about 50 pages or so, which we have a copy and will present to the Commission as well. The point here is that Piecers has been focused on monitoring, measuring, and controlling external manager fees every day since I've been the executive director. This is not a new priority at Piecers. It was very clear in our discussion and presentation to the governor that he had personally reviewed all the information we presented and had a complete grasp of the information provided. He asked some questions regarding why Piecers managed funds internally when we managed externally, how we monitor managers, how we decide between active and passive managers. And he expressed an interest in keeping external manager fees as low as possible. But we quickly moved on to other subjects, having, we believe, satisfied his concerns about our approach. In the ensuing year, we reduced our reliance on external managers, and we requested additional complement positions to further support Piecers' internal investment operations. This move to expand internal management significantly lowered external manager fees while we awaited the additional complement. In fact, the governor issued a press statement in March 2016 noting our accomplishment. Unfortunately, the further reduction was stalled when it took us approximately 18 months to receive approval for 7 of the 15 additional investment office positions we had requested. And that goes to something that Director Sanchez mentioned in terms of autonomy and control over our complement. The 7 positions, once they were approved, were filled, and they have continued to add significant talent to our investment office, which now includes, among other qualifications, 13 chartered financial analysts and 16 MBAs. Like other large public pension funds with best-in-class internal investment operations, we believe a part of the solution to large external manager fees is to build a strong internal investment platform, with the skills and the tools necessary to engage in the kind of sophisticated pension asset management that other comparable public funds do. PSER's investment professionals currently manage 19 portfolios in-house with net asset value of over $23 billion in-house, saving approximately $39 million a year in external manager fees. The amount managed internally has increased from $6 billion just 3 years ago, from 30% to the fund's assets to 36% today. At this point, I'd like to turn over the next portion of our testimony to CIO Jim Grossman to present PSER's fee savings plan. This plan was created in response to Act 5, when we saw the provision that would target $1.5 billion savings, and also in response to Treasurer Torsella's sponsored board resolution challenging PSER's investment professionals to work with our consultants to create a fee savings plan. The plan was presented and adopted by the board at the August 2018 meeting. However, the plan is a fluid and flexible plan of action which will adapt and change as necessary going forward. At this point, I'll let Mr. Grossman talk about the plan.
Thanks, Glenn. Thank you, Commissioners. Section 8538 of Act 5 established a goal for PSERS to develop a plan to save $1.5 billion in management fees over 30 years. PSERS Retirement Board Resolution 2017-41, passed December 8, 2017, was developed by the Treasurer and our Executive Director. It directed PSERS investment professionals and the Board's investment consultants to come up with a fee savings plan to present to the Board. PSERS investment professionals presented such a plan at its August 2018 Board meeting. The plan focused on investment manager cost efficiency, assumed no changes to the strategic asset allocation, included those portions of the asset allocation where we expected fees to increase in the future, and was to be implemented over 3 years. Annual savings were converted to cumulative compounded savings over a 30-year period. PSERS investment professionals took a two-pronged approach to generate fee savings. The first was to establish a fee plan to renegotiate management fee arrangements to create a better alignment of interest between PSERS and each investment manager. The goal was to decrease the guaranteed fees, or base fees, in exchange for a profit-sharing arrangement on returns above a negotiated benchmark. Estimated savings from these reduced guaranteed fees amounted to over $1.5 billion compounded over 30 years. The second was to expand internal management and bring additional assets in-house at a lower cost than external management. Net of the cost of an additional 9 investment professionals needed, we estimated savings of over $900 million compounded over 30 years. Together, the cumulative fee savings are $2.4 billion compounded over 30 years, which represent a 9.6% annual reduction in base management fees. The detailed presentation is posted on our website and has been provided to the Commission, and a copy looks like this. The fee savings plan crafted is by no means an end to our efforts to reduce management fees and better align the interest of the investment managers with PSERS. Since the plan was prepared, we've identified over $350 million in additional cumulative base fee savings compounded over 30 years. The cumulative fee savings have now increased to $2.8 billion compounded over 30 years, a 10.4% annual reduction in base management fees. In addition, we've aggressively negotiated management fee deals with new managers and mandates. In 2 cases recently, we entered into agreements with 0 base management fees, and the investment manager only gets a share of the profits generated. Plus, we are currently negotiating 2 other similar deals. In other cases, we have continued our long-standing practice of obtaining fee discounts for our large commitments and for being in the first closing of a fund. We also aggressively negotiate the less obvious management fee terms as well, including hurdle rates and catch-up provisions. It is important to recognize that the long-term nature of our pension plan positions us to drive fees down even further because managers are generally willing to accept lower fees in exchange for stable, patient capital. Whenever possible, we attempt to make the most of this natural advantage. One criticism of the fee savings plan we'd like to address relates to the profit-sharing fees. We've received questions about the possibility that total management fees, base fees plus profit shares may increase under this plan. To be clear, the plan has at least a 9.6% reduction in base management fees. Base management fees are guaranteed no matter the performance. So overall, base management fees are going down. If we are so fortunate as to have very strong performance by the investment managers, then the profit sharing component of the total fees will go up. If profit share goes up, so does our investment income. For example, if a manager has a 20% profit share and earns $10 million above their benchmark, then Peasers is better off by $8 million while the manager collects an additional $2 million. Our interests are aligned. Higher investment income means lower required contributions and, by extension, lower taxes for the Commonwealth and school employers. In government, increased costs are generally frowned upon since increased taxes are required to fund them. In investment management, increased profit-sharing fees are funded by increased performance, which has the opposite effect: decreased costs to the government, as well as less taxes needed to fund the pension benefit. It's a win-win-win. It's a win for Peasers members, the taxpayer, and the investment manager. And importantly, a profit share focuses the manager's efforts on performance rather than simply growing assets under management to collect more base fees, an activity that often reduces the likelihood of outperformance. Another item to note that we have not included in our fee savings plan are any savings from not having to pay carried interest in our private equity co-investment program or reduced carried interest in our real estate co-investment program. The private equity co-investment program allows us to invest in private companies at no cost, no fee, no carry. The real estate co-investment program allows us to invest in private real estate at reduced fee and reduced carry. Based on the size and success of our private equity co-investment program alone, which has an internal rate of return of over 23%, the savings would be significant. Also not included in our fee savings plan are other areas of consideration recommended by our investment consultants, including an increased pursuit of strategic partnerships, direct investing in private markets, secondary sales of non-core fee-paying private market funds, sidecar co-investment vehicles, and non-management fee reductions for new investments such as 100% fee offsets. Additionally, our size, longevity, and reputation position us as the perfect partner for new managers who require an anchor investor. Such seed investors in new investment managers commonly negotiate a perpetual share of revenue generated by the new manager, effectively transforming management fees into a new profit center for Peasers. These are all areas that merit further exploration. We are open to considering any fee savings recommendations that, 1, enhance Peasers' net of fee return, and 2, do not increase the risk of the investment program. The investment professionals at Peasers are always looking to negotiate the fairest fee deal possible. To that end, we've recently implemented a formal external manager fee policy to document our objectives in fee negotiations. In addition, we've instituted a formal internal policy of reviewing all fee arrangements at least once every 2.5 years to ensure that each fee arrangement is still appropriate. All fee negotiations are now formally documented and saved in our document management system in accordance with the recommendations from the Auditor General. Now I'll turn it back over to Glenn to cover our recommendations. Thank you.